Welcome to Real Estate Investing Abundance, the show for busy, fulfilled professionals like you to learn how to develop financial independence built on solid, passive real estate investments. Now, here is your host, Dr. Alan Lomax.
Hello, enlightened investors. I'm so glad to be back with you again today. With us today is Matthew Ryan, who is an investor and who is passionate about building companies that tackle socioeconomic issues through entrepreneurship. He strongly believes in the ability of the private sector to solve society's most complex problems, that entrepreneurs are the foundation of all of that. So, Matthew, share with us a memorable experience that helped you to be who you are today.
Yeah, it really goes back to my first true investment property in an up-and-coming neighborhood in Charlotte, North Carolina. It was a foreclosed duplex. Neighborhood was rapidly changing. My now daughter ended up going to elementary school down the street from there, and my now wife ended up moving into the other side of it at the time while we were still dating. And we ended up befriending a neighbor 2 doors down who worked at my daughter's school, and Miss Pam. And Miss Pam walked to school every day, the 5 or 6 blocks, where she was a cook. Found out later, because she would babysit for us from time to time, that she would take the bus to her second shift at night. Had been in that neighborhood for several years. And my wife and I were talking one night. We're like, what happens to the Miss Pams as more people kind of move into this neighborhood and start buying up places to renovate and to live in and so on and so forth. And so I took what was essentially a 1-page idea to a local developer that was referred to me, what I call the Miss Pam project, which is how we were going to revitalize this neighborhood with kind of a focus on what I presume is now considered affordable housing, but also for-profit housing model. And he was very, very nice and met with me and, applauded the idea, said, hey, I think this is a great idea, but you have one mission on top of servicing the Miss Pams. You need to make a strong return for your investors, whatever you do. And so I muddled around for another year or so and ended up moving to San Francisco, and later just, what was supposed to be Revive was supposed to be just focusing on rehabilitating, older buildings. I was actually going to move into maybe custom home building or subcontracting. Ended up being a much larger company in that context, focusing on community revitalization with a focus on for-profit development and innovative approaches to affordable housing. That was the catalyst for me, and it really piggybacked on my experience in energy efficiency and green building space, which I had spent about 5.5, 6 years bootstrapping my first company around, implementing that in residential and light commercial buildings. So I really understood the importance of how not only those neighborhoods, but also the efficiency of those buildings and low utility cost and good indoor air and all those things really benefited people of lower middle income to middle income. And, those are the people that need to have the walkable, bikeable, transit-oriented housing. And then it really shouldn't just be for the affluent. And that was a big catalyst for me. And it's really, it's driven my why for obviously a long period of time.
Very interesting how all of that came about through actually compassion, as well as the fact that the seed was planted and it really didn't start coming to fruition until 2 or 3 or 4 years later. I don't think that's probably not particularly unusual for good ideas. They have to simmer, and they don't just come together overnight. So that was the idea. You said you moved to San Francisco, which would seem to me like that would be an even more challenging environment. It's a much more expensive environment. It is in many ways probably already gentrified in many different aspects than what Charlotte was. So how did you get started in San Francisco?
Yeah, and I want to clarify that we have yet to develop an asset in San Francisco. We toyed around with the Oakland, Berkeley markets and have largely navigated away from those markets. And I'll just say very quickly that, San Francisco's tried really hard to combat this idea of gentrification, and they've instituted a lot of destructive policies, housing policies, which has, been academically proven that it really hasn't helped. And so that was another really big catalyst moving to San Francisco was, wow, there's a very strong emphasis on this. There's a very strong emphasis on trying to address this problem. but we were just inundated with the policy failures. And it's been very much part of the culture here in San Francisco. It's one of the most unaffordable places to live in the country, right? And so, yeah, I mean, that was a very interesting and really a core element to my development as a company, and also thinking and looking at, well, outside of just the product solutions, the real estate solutions that we're trying to provide, what are the appropriate policies that we really need to put in place? But going back to your question about what got me started, well, I was, cash flowing that duplex really well, but I had created a lot of equity. And a family member, a cousin of mine, was like, well, why don't you just sell it? And I was selling my condo that I had also bought as a short sale during the financial crisis, fixed up. I had house hacked it, got a roommate. I had kind of been toying around with it. I said, that's a great idea. So I ended up just selling those two deals, 1031ing into an industrial building that my family ended up leasing back from me. That gave me the cash flow, and I pulled some cash out from that equity and used that capital for living expenses and to essentially fund, the investment company, the syndication company, to get started. And probably a year and a half to 2 years later, we tried to staff, didn't work out with some people early on. We ended up buying our first value add deal in Sacramento and doing a very similar situation where we over levered, as much as we possibly could, cashed out, refinance, used the proceeds to pay off our first round investors, and then, use that cash to continue to fund operations. And we've just kind of been repeating on that model with family and friends money for quite some time.
Mhm. Well, I mean, that's certainly a good way to get started, and it has worked for a lot of people. Um, but you said that you have discontinued that, or are you still in that process? Uh,
Yeah.
what's going on with you now?
Yeah. So we're actively we've secured two co-living projects. And really what they were residential buildings that converted back to office, and we're converting them back to residential. And they're good setups for co-living, which is our rent a bedroom model, which we've been really bullish on that market segment and happy to talk about it more. But fundamentally, they were just good real estate deals. They were cheaper relative to comps. We were able to cash flow them after renovation. We were purchased at substantial discounts. And one of those projects actually was on a 15,000 square foot lot. And we're splitting off that lot to then build vertical to do another co-living, small scale co-living deal. To your question, as far as why we adjusted that model, now we've got enough of a track record, or so we think, that we can raise capital from outside investors. We've been actively doing that for about almost 2.5 years now. It's a very intensive process. It hasn't always been marred in success, and still have family and friend capital that's available to us. But we went from basically one or two deals to now having close to 13.5 million of assets under management that we're currently stabilizing. So a lot of that was a combination of selling other deals, using that family and friends capital. But, the reason why we pivoted was really is just because at this point, it was risky to continue to over leverage those deals, right? To bring capital on top of debt. I really wouldn't recommend it. I know people do it all the time. And it was actually, that strategy was recommended to me by a fellow syndicator, because I was going to syndicate our first value add deal. And he goes, dude, you don't need to syndicate this. Just take it down private debt, and then refinance out, basically a BRRRR strategy, but for value add apartments, right? And, I think the current economic conditions have proven why that's a very risky strategy. And we saw a lot of that coming. And so that's part of the reason we've been actively trying to build our LP base, really hone in on a track record about this specific product that we've been bullish on since about 2019, and actively, trying to get deals secured in that market. So that's the reason for kind of call it the pivot, but, obviously just getting into a point where we want to continue to bring more and more investors into this great product that we're trying to build a portfolio on and become a leader in.
So you said you're not doing this in San Francisco itself. You said you're doing it. You're doing this in Berkeley.
We were trying to do it in Oakley and Berkeley, but we really struggled to find product that fit our needs. A lot of what we were focused on was small scale co-living of 10 to 25 beds. Very hard to find deals there. Very difficult laws to navigate. So post pandemic, these office deals that were previously residential converted back to office and back on, we found deals in Sacramento and Denver, which we felt still fit our criteria as far as great markets that had good macro fundamentals, and then had very interesting neighborhoods in the specific markets that were of interest to us. And yes, that was really the catalyst for us. And right now we're trying to get a lot more aggressive in Sacramento and Denver, because we've just seen that, they're a little bit more purple politically. There's always challenges in California, but Sacramento's interestingly been one of the better performing building and planning departments that we worked with. So we're navigating a lot of those issues as well. And so that's kind of our key. We'd like to open up another market here in the future, but those are the two markets that we're actively focused on right now.
Well, I would think those two markets could keep you quite busy in and of themselves for several years to come. Where do you actually see this co-living going? And you've explained a little bit as to why this is so important to you, but go into a little bit more detail.
Yeah. As I tell everyone, the most important thing to realize about co-living is that this isn't anything new, right? People moving into major cities and maybe getting a 3 or 4 or 5 bedroom apartment, because once you divvy that up versus a studio apartment, you may save $400 to $600 a head, right, per bedroom. We call it the Craigslist model, right? This has been going on for years, if not decades, even before Craigslist. This isn't anything new. It's kind of an expanded model of some people say dormitory. It's a little bit different, right, for young professionals. And the other big issue or reason that we're super bullish on it is there's 45 million Gen Zs, not the millennials, but the generation after them, that are going to be hitting the workforce over the next decade. And they're one of the most rent burdened classes of renters, in terms of spending almost 45% of their income to rent. And so that's the benefit of co-living, is that you're experiencing $250 to maybe $500 a month in savings versus going out and renting a studio. You get to plug into a network of people, a community, and ultimately save some money to maybe one day move into your own apartment, and not have to be able to be working paycheck to paycheck and be in a situation where you literally have no disposable income. And so the affordability component, without a tax subsidy, without having to go and get tax credits, and we're effectively delivering, newly renovated, almost a class A product. I say almost because, we're renovating them new, but they don't have gyms. They don't have the common amenities that you would see, with an institutional grade class A product. But, we just don't think that there's a lot of product that can compete with that. And that we think the affordability for that generation is going to be their number one issue, in addition to a more frictionless process versus trying to have to go out on Craigslist or find roommates and do those awkward interviews. Anyone who's ever tried to move to a city, it's a really difficult housing model to engage in and be a part of. I've actually been a part of that when I moved to San Francisco, and it just sucks. That's the simplest way to put it. It's not fun. And the sophistication of the co-living operators, the existing European model that's been existing for even longer than the US market, it's just proven. And we're just at an adoption cycle now where it's getting ready to rapidly expand, and we feel like our investors are going to greatly benefit if they get in now and continue to work with a developer that's going to expand in the space. And we're trying to be one of those players.
Yeah, the future scenario doesn't look good for that particular generation. Wages have been stagnant for the last 40 years while productivity has grown in leaps and bounds, and the wealth divide between the rich and the poor is just horrendous in this particular day and age. So that generation is having a difficult time. And like you said, their 45% of their paycheck is going to rental, which it reasonably should never be really over 30%. So they are really stuck between a rock and a hard place. So you had mentioned the problem of municipal policies. At the same time, you said that San Francisco has been really conscientious about gentrification, and they seemingly want to do something about it, but they are at the same time putting policies in place that are standing in the way of achieving what they would like to achieve. I suspect that San Francisco is not the only community facing that kind of thing. Do you see any short-term solutions there, and what are those, and what really would be the long-term solution to those policy issues?
Yeah, I mean, it's not implementing rent control laws or just severely restricting some of the rent control laws to just maybe just cause evictions and perhaps having some form of cap. But I mean, all the academics have come out and said that rent control actually doesn't benefit the people it is intended to benefit, and actually benefits higher to, middle income to higher middle income earners, actually more higher income earners than it does, the lower middle to middle income earners. And it creates inventory controls, right? So it's just, that's a very slippery slope to even be pro rent control, but there is some merits to some of the things that they're bringing up there. Inclusionary zoning. I mean, inclusionary zoning is a horrible policy that's basically saying we aren't producing enough units at a quote affordable rent, that 30% threshold. So we're going to put that burden on developers. And if you want to develop, you got to make 20% of your apartments, and maybe we'll negotiate and let you do more units for zoning, based on the existing zoning that's there. And that really brings me to what I believe to be is the core issue, which is we need massive zoning reform. Houston's done it. They don't have zoning laws. There's been a continual movement of reducing parking requirements, especially around transit. I mean, these are policies we need to get out of our own way and quit letting the bureaucracies of cities stand in the way of development. Everyone wants to talk about the fact that developers aren't producing housing at those rent thresholds. Well, the fact remains is that for the last 3 to 4 decades, we just haven't produced enough housing that's needed in general. And it's just comes back to basic laws of supply and demand. Okay. Beyond the planning and zoning reforms, because of the COVID-19 pandemic, now we're experiencing massive staffing shortages in already constrained building departments. We're seeing timelines nearly double. Okay. And for small scale development, which as a boutique developer, we've been very passionate about, we feel it's a very strong solution to this holistic problem of development, getting smaller developers involved, building product of 10 to 30 units, which is just financially unfeasible at this point in most markets in the US. We need to reduce the barriers for them and in general to the larger developers as well. Because what's happened is it's so difficult and challenging for a developer to get started and do all the things that encompass development and the risk associated with it, that we've created a massive amount of consolidation where only the largest and the biggest can develop assets. And they're fighting with these bureaucracies continually. And it's become a pay to play model. And it's just unfortunate. When we talk about solutions for housing, how about a dashboard for every city planner, just like the city of Denver does, even though they've been guilty of not even coming close to hitting their timelines, where they're showing estimated processing timelines and metrics around how often they're actually hitting those timelines, and mandating that building departments and planning departments start actually meeting those deadlines. And if they don't, then maybe the state steps in and provides additional funding or takes away local control. That's happening here in the state of California because the NIMBYs, a few members of the community have been able to go in and just hijack the processes of development, the bureaucracies that have been created, and say, we don't want that development here, even without any good merit. And that's fundamentally stood in the way, in addition to not getting out of our own way on the government side of things. And it has to stop. And I mean, that's the only way we're going to meet the housing goals and needs of the future is if we get out of our own way and just allow the developers to be able to build, and the capital markets will respond. And anyone who wants to argue that supply demand doesn't matter, you avoid them like the plague, because it's just, we're seeing this right now. Apartment rents are dropping, not because we're overbuilding, but because demand is dropping. And there is some supply hitting the ground. And so, this continual rhetoric that the laws of supply and demand don't matter that happens in housing, it's very maddening to see. I think that's from developers and the apartment association. I think we've really got to look inward and see how well we're actually messaging this to the voter base, because the same old people are, especially here in San Francisco, it's very maddening, are continually selling the same, tax and redistribute model. We need to stick it to these developers and add more mandates, and they need to come down to us and, beg for projects in return for all these things. And what's happening is houses aren't getting built, and affordability is escalating, and the problem is getting worse. And they keep saying, but we need more affordable housing. We need more. And it's just this cyclical process. And the average voter can't understand it all. It's very complex. It's very challenging. And they look at the developers as the enemy and not the people that are there to solve their problems. And it's unfortunate, but as developers, and I think as an industry, we got to take that message back.
Well, I mean, I can see, they have created a pay for play situation, which is really the last thing they ever wanted, because they're working with the worst of the worst, because those who've learned how to pay to play have learned their game and they're not interested in people like you coming into the market to compete with their product. And so they've just created a vicious cycle, the very cycle that they really probably have been trying to avoid. So they probably don't know how to get out of it themselves. Sad situation because it is, as always, it's those with the fewest of resources are the ones who are going to suffer because of that. The situation looks fairly dire in terms of at least the next few years here. Applications for mortgages are at an all-time low, 29 years. I mean, even lower than they were in 2008. And why the real estate market has not totally crashed and bottomed out is just not making any particular sense to me. At the same time that this is going on, as you just mentioned, rents have declined a tad bit. So all of these dynamics are not really making particular sense to me. If people are not getting mortgages, that means that they are probably renting. So why are rents declining?
That's a great question. I mean, I think it's a mixed bag, right? I think we do have a lot of Class A product that's hitting the ground. And the thing we have to be careful of too is like when we talk about the reporting of rents, the majority of the reporting happens at institutional grade, right? Very large complexes that report that information back to Yardi and use those systems. There's still an undercurrent of small scale we call them mom and pop owners, right? Sub-institutional and below, who advertise on Craigslist, who advertise on Zillow. And so not all those metrics are picked up. So I think what we're seeing is you're starting to see rents decline at that Class A product, as they traditionally have, at the top of the rental market. And, from a housing affordability perspective, yeah, of course, interest rates are going up at a point in time when the last 2 years, the average home price increased almost 14, 15% year over year.
Mm-hmm.
So we have a very inflated asset value on top of now incredibly high borrowing rates. So there is going to be some moderation there. I mean, as far as the continual drop in rents, I've read and heard that we do have a historic level of supply hitting the ground, which is great for renters, fantastic, right? Not so good for developers, but I do hear people talking about that absorption is extremely high, right? So while rents are dropping a little bit, maybe there's some concessions there. The thing that people have to realize is like the COVID pandemic really accelerated rents in an unsustainable way, in my opinion, anyways, and that we could just be seeing a little bit of regression. I bet if you put it on a chart, rents are still above 2020 levels, right? So that was kind of a black swan event that had the opposite effect. So, and drove a lot of, I think, just how do I describe this? It drove demand in a very characteristic way. And I don't think that rent drop, and I'll be willing to be wrong on this one, is going to continue much further other than moderating maybe at 2020 levels. And because of the rising interest rates, we are going to see a drying up of development projects simply because of construction cost and the associated borrowing costs. So I think we're going to moderate back down. And I think it's a pivotal time where, hopefully labor comes down and materials come down and developers can start penciling deals and people start making moves again. Because if you remember in 2011, 12, 13, there was a massive uprising in rents because nobody built and we got behind on our deliverable units. And there's no reason why this situation couldn't create that problem again. So I think this is a blip on the radar for what is still a very long-term 10-year problem, where we're still going to see rents moderate. And I mean, the fact remains rents got so high and disproportionate to income that I think it had to come down, right? There was no fundamental sense of it. But I wish I had a better explanation that was more detailed and statistical, right? The beauty of what we're focused on in co-living is we're not delivering rents at the top of the market. We're delivering units at the bottom 20% of the rental market with basically a brand new product, right? So we're competing with Class C rents with a far more favorable product, just a different living situation. And so for us, we kind of stay out of that because it concerns us and maybe it'll create some downward compression, but traditionally you haven't seen a lot of that compression in that marketplace for Class C apartments. You do, but you see it in the terms of vacancy, right? And turnover, not so much in actual rents.
Well, so much more to talk about here, but we're running out of time. So Matthew, tell us how it is that we can get in touch with you to take advantage of your knowledge and wisdom.
Thank you. Yeah, just revive, re-viv.com. That's our website. There's a scheduling tool on there where you can get in touch with me if you want to talk about one of our prospective deals. One of our Sacramento deals still open, still accepting small pools of investors that have interest, and then we're also raising capital for our new, called semi-blind pool that will be generating new deals in Denver and Sacramento for investors who are interested in the co-living piece. So hit me up there and be happy to schedule a chat and connect with you that way. And then of course, we're on all the social media, so you can always catch us there. We do a lot of postings on LinkedIn. So always great to catch up with people there.
Okay, great. All of those links will be in the show notes. So, Matthew, thank you so much for being with us. It has been a pleasure meeting you and getting into the micro apartment industry. Thanks so much for being with us.
Appreciate it, Alan. Thanks for having me.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steve Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steve Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steve Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at stevetalker.com.